Oh, I gotta wear my Swans hat.
Equity, mate!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome to another episode of Equity Mates, or should I say, greeting lords and ladies. You've ventured into another chapter of Equity Mates, a chronicle that shadows our quest in the realm of coin and commerce. Be you a green squire or a meister akin to Warren Buffett, our purpose is to shatter the walls that keep you from your first coin to your regular, rightful dividends. If this is your maiden journey with us, I bid you welcome. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. Any thoughts?
Another perfectly normal intro from you. Well, it's like medieval.
It is the vibe, yeah.
How specific do I have to be?
Well, this is person specific. I think all of them from here. But if you get it in the realm,
like a king or
yes, yes.
This is how
fictional king.
King Charles still talks today. A fictional king.
Fictional king, very popular while we were through university. Very popular TV show.
Like Game of Thrones.
Yes, along those lines. I was Ned Stark, if you couldn't tell.
Winter is coming.
Oh, that's highly specific.
Well, I mean, last year, it is.
Fair enough. You don't win them all.
One day you'll get it. One day you'll get it.
Great.
Well, we've got a massive show. If you have joined us for the first time, a huge welcome. We do have a podcast called Get Started Investing if you're just trying to get up to speed with the basics. So go and check that out. But otherwise, we're ready to jump into a huge episode. We've got a question from a community member, Steve, that carries on from our discussion from our interview with Kelly Shue on ESG. We're going to continue Alex's mentored journey with his mentor, Andrew Page. But first, Ren, there's plenty going on in markets and the news. So we're going to start there.
Yeah, there is so much going on. I mean, let's start in Australia, and let's start with, I think, some good news. Well, some better news, the inflation and interest rate stories. So inflation came in, the rate of inflation is slowing, 4.9%. That's good.
It's better.
It's better. It's true. That's a better way to phrase that.
It's better.
And as a result, the RBA held interest rates steady for the third month in a row.
Yes.
So we had 12 increases in 13 months. We went from 0.1% to 4.1%. But since then, so that was between May 2022 and June 2023. And since then, July, August, September, we've had holding
pattern.
That's good.
I mean, yeah, it depends which way you want to look at it. The reason we say it's better is because obviously inflation has been high, but the Reserve Bank tends to, want to try and keep inflation within that band of 2 to 3%. So a bit to go.
Yeah. Andrew and I speak about this, and some central banks are going the other way, and they're just saying, oh, well, our inflation target's now 4 to 5%.
Yeah.
So
it's all relative.
I think
get out of jail free.
The 2% was an arbitrary number. Like, there's no scientific or economic basis to it, like so much of economics. But I think it was a New Zealand economist that suggested 2%, and everyone said that feels about right. Like I said, some central banks are taking the other option, which is just raise the number.
Just raise it up to the band we're in.
Move the goalposts.
Job done. So yes, Philip Lowe, who was the RBA governor, his contract is up. So his last meeting was the Tuesday that we've just had. And yes, he kept rates at 4.2%. Tough job for the new...
4.1.
4.1. Tough job for the new governor coming in, Michelle Bullock. Because...
I don't feel sorry for her. She's on like a $900,000 pay packet.
I know.
Well, that's what Phil was on. I assume she got the same.
Yeah.
I would wear the weight of interest rate decisions for $900,000 a year.
Would you?
Yeah. Well, you wouldn't?
He copped it pretty hard over the last sort of 18 months.
Yeah.
Yeah. And now he's out.
Hey, we cop it hard on social media. Have you seen our TikTok comments? And we certainly don't get $900,000 a year.
This is true. For me, though, it's interesting, Ren, like the current sentiment is, I feel like it's mixed. I think there's a general sense of optimism that probably didn't exist 6 to 8 months ago. The markets, this month, they've sort of ended down, but overall we're still seeing some pretty positive returns. But what I find interesting is that, that they say statistically the lag effect of interest rate rises is not generally felt until sort of the 12-month mark. And as you said at the top there, we've gone from 0.1% to 4.1% in 12 months, which is an historical rate rise, the speed of that. And so is now the time to start really thinking, what is going to be the effect of this rate rise?
Well, let me answer that for you with some recent data that came out from the RBA this morning as we're recording. The interest that Australians pay on their mortgages has doubled from last year. I don't have a mortgage, neither do you, but we both hope to have one and feel that pain soon. $83 billion annually in interest. That's double what it was a year ago. In the June quarter, from this ABS data, Australian households paid $24.5 billion in interest. $24.5 billion, annualize that, it's $100 billion. So, but $24.5 billion in the quarter compared to $11.9 billion the same quarter last year. So to answer your question, what are the effects going to be? That's where it's felt first. And there's a wealth effect there across the economy. Andrew and I spoke about the retailers, and we've just come through earnings season or reporting season, and everyone's numbers were okay considering. They were pretty good considering. But the retailers also give investors a view of how they've started the next financial year, because by the time they're reporting, they have, sort of 4 to 8 weeks of data for the new year. And a lot of them were like, this year has started very soft.
Yeah. Well, yeah, consumer spending is down. We also know that through COVID and sort of over the last 18 months, household savings were at sort of record high. Everyone putting cash away. That's now back down to levels pre-COVID, and the household saving ratios are going down. People drawing on their savings for this increase in interest rates. I mean, at the end of the day, what's happening is what is supposed to happen when interest rates go up. So
textbook.
So
So
I think in terms of a governance point of view and bringing heat out of the economy and whatnot, the effects it's happening. How severe that's going to be going from 0.1 to 4.1, that's the question for me.
Yeah, so I think there's a little bit of optimism in the market, but it's important to temper that because there's more to play out. But let's talk about someone who's certainly not optimistic, which is the big news of this week, Alan Joyce. He's out.
I reckon he'd be feeling pretty optimistic. He's just gone, see ya, with $10.8 million in the bank.
Yeah. But for me, like 15 years in the spotlight, running one of the most iconic companies in Australia, you leave on this note.
Yeah.
You can't help but feel tarnished.
I mean, it's his own doing. I don't feel sorry for him. Like he had alternative options. He didn't have to like. It's not like he woke up and went, "Wow, this came out of nowhere."
Yeah. Well, yeah.
He's just going to leave with with a sour taste. He's going to leave, leaving a sour taste in our mouth.
Yeah. So we eloquent as always. we did an episode on The Dive, our business news podcast, where we unpacked the 3 big scandals and some of the minor ones. We don't need to cover that here. Everyone's heard about it on the news, but you can go check out that episode. We'll include a link in the show notes. But looking at the share price return, so Alan Joyce joined in 2008, became CEO in 2008. From January 2008 to today, how much do you reckon the Qantas share price is up?
Nothing. Less than 5%.
Yeah, 4%. Geez, you do host an investing podcast. And they basically didn't pay dividends in that time. They did in 17, 18, 19, but not a massive shareholder return. We should say, though, he actually came in November 2008. From there, depths of the GFC, Qantas' share price is up about 120%. But he's universally seen as like a great CEO. I think you and I even had a back and forth on an Equity Mates episode where you called him like a great manager. Does that ring a bell?
Yeah, it does.
Yeah. And for me, he is the quintessential example of like the classic Milton Friedman, neoliberal Chicago school CEO. And what I mean by that is like the 70s, mainly the 80s, there was this view that like businesses looked after their communities that they were in and their employees and stuff like that. In walks Milton Friedman and says the only obligation a CEO has is to their shareholders, their equity shareholders, and everything else is sort of immaterial. And that led to, you know, the corporate culture that we've had over the last 50 years, really exemplified in the 80s and carried on there. It's like shareholders are what matters and your obligation is to your shareholders. And a generation of professional CEOs and executives have come in with that ethos. And I think Alan Joyce sums that up because there's a list of people that he's fought with. Qantas pilots, Qantas baggage handlers,
everyone,
airports, the government, Australia as a whole. But he's like, for him, the one thing that he's been laser focused on, and all of the scandals that we're talking about now, how he would defend himself. My only obligation is to the Qantas shareholders, and I acted in their best interests.
Yeah, it's been his line.
Yeah,
and shareholders. Well, I don't know if they're happy or not, but I actually saw on ABC the other day that he's actually lost them more money over his tenure than he's made them.
Like in terms of annual profits and losses?
Yeah. He's finished on a high, obviously, $1.6 billion profit or whatever.
Post-tax. Pre-tax, it was almost 2.5.
Yeah. Anyway,
hasn't paid a lot of tax over his journey.
Hasn't paid a lot, no. What is also a great thing, one thing you should do is look up his... Look up what he looked like when he started as a CEO. Scruffy, open tie, a bit sort of like, and look at what he looks like now. Yeah, the progression of him over the last 15 years. Slicked back hair, nice glasses, beautiful suits. It's worth having a look.
Sorry, there's an effect, and I just can't Google it, where actors get hotter as they go through the seasons because they... get more money, obviously.
Well, that's kind of what I'm implying. You can see his pay packet coming in.
Yeah, and I think there's a term for it, but I couldn't Google it. So, anyway.
But anyway, look, speaking of big jobs for the new RBA governor, a huge job ahead for the new Qantas CEO.
Vanessa Hudson. Is she interim or...
No, she's
legit?
in. She's in. Yeah. In sooner than I think she was anticipating.
Been with Qantas since 1994.
Yeah.
That's a company woman.
That is, yes. Yeah. And
that's what you could have been at Woolies if you stuck it out.
No, thank you. A lot of work to do. There is serious brand damage for Qantas at the moment. And I mean, if you're the competitor, now's the time to seriously strike.
Yeah, well, Qatar Airways orchestrated Alan Joyce's downfall.
Yeah, I reckon that'll get overturned.
Definitely. No, the Transport Minister, Dan Tehan, has publicly said Qatar can reapply. Oh. And like the amount of public pressure, you're not going to be the trade minister that turns that down.
No.
Yeah. Which is good for us.
Great.
I do feel sorry for Australia's airlines competing with government-backed airlines from overseas. Like the amount of losses that they can absorb, the pricing that they can put in the market. That feeling of sorry is obviously tempered by the fact that Qantas had a record profit this year. Clear caveat there. But being the CEO of an international airline would be one of the tougher gigs.
Very tough.
A lot easier to be CEO of a duopoly supermarket.
Much harder. Anyway, let's keep moving. Ren, last week we spoke about the IPO window opening. We also put up a post on our Instagram. And news continues to flow. There's a huge IPO on the table.
A huge IPO that everyone has been affected by, but no one knows.
Yeah. And that is ARM, which is one of UK's, or if not UK's largest chip designer, and not potato chips, but microchips. Important clarification.
They make hardware that's in almost every smartphone.
So they're IPOing at a valuation between $47 and $51 a share, which is essentially a $52 billion valuation at IPO. So a huge IPO coming out at I think they're timing this incredibly well given what's going on in this space. Like it is hot. Yeah. So they're striking while the iron's hot. Interestingly, one of the largest owners currently is SoftBank.
Yeah,
So maybe they're finally going to get something right.
Maybe. I think full owner?
I don't know. I thought they were part. Okay.
Oh, okay. Yeah, so Instacart, which we spoke about last week, Arm that you've mentioned there, both profitable, which you like to see.
Yes.
Profitable tech companies, who would have thought?
Yeah, well, I mean, the environment we're in, you're not going to get very far if you're not.
Yeah. And there's one other IPO that is coming out, Klaviyo. Have you heard of them?
No.
I hadn't heard of them either. Also profitable, like marketing tech, email automation, that kind of stuff. But here's why they're fascinating for me. So Shopify, the e-commerce platform where if you want to spin up a e-commerce store.
I'm doing it. Yeah, drop shipping.
On Get Started Investing, Bryce is starting a drop shipping business.
Yeah.
You'll probably use Shopify for that.
100%.
There you go. You will use Shopify for that. Shopify invested $100 million into Klaviyo in August 2022, which is a heap of money. But
Yes.
just pause on that for a second, because when I read that, like the guts to do that from Shopify was pretty amazing. Shopify's not profitable, and it dropped $100 million. Like that in itself is a massive step for an unprofitable company.
In 2022 as well.
But that's the more amazing thing. August 2022, Shopify's share price had fallen more than 80% in less than a year. From November 2021 to August 2022, more than 80%. Like there would have been, like, people would have been panicking in HQ. There were layoffs. Like things were not good in unprofitable tech land, and in particular, Shopify was like a real example of that. To have the, I guess, long-term vision, to have the conviction, to not hoard that $100 million and keep your balance sheet strong, but to invest it, like that's a sign of a company that's seeing through the cycle.
Yeah, it's high conviction, that's for sure. Will it pay off though?
Yeah. And like, now, to be fair, it's like a $90 billion market cap or something. So like, this is a big company.
Got the cash.
They've got a lot of big customers.
Yeah.
So let's not make this more than it is. But when I read that, I was like, that is pretty amazing.
Respect.
Yeah.
So it's an email marketing company or email company.
Yeah, marketing automation and stuff like that. Also profitable. So Instacart, Klaviyo, number of profitable IPOs coming, and they're probably the wedge that then
kicks it all off.
Kicks the door open, and then a number of unprofitable companies come through.
Kick it off.
IPO windows open.
Away
investors
we go.
are euphoric, and we're in a bull market again.
Let's go. All right, well, that's the news for the week. Ren, let's move on to Mentored. Now, if you've just joined us for the first time, to quickly get you up to speed, at the start of the year, Alec and I just wanted to pair up with an expert investor to improve our own investing skills. And so Ren chose Andrew Page and I chose Henry Jennings. Now, Henry is overseas enjoying himself in Italy at the moment, so I'll be catching up with him in the next few weeks. But Ren touch base with Andrew.
Yeah, and in this, I just really wanted to catch up, touch base, and get his sense on what's happened over the past few months with earnings season, reporting season. He's particularly focused on small caps, so also to hear what happened in the smaller end of the market. Andrew, good to see you again.
G'day, mate. Good to see you.
Well, I've been on holidays for a few weeks and haven't really been thinking about investing too much. And what have I missed?
Well, I don't know. Maybe it's always been thus, but it feels like the market is really jittery right now. As you know, Alec, I love small caps. You know, it's not that unusual to see double-digit percentage moves in a day. Gut churning kind of stuff, but you see it, right? You don't usually see it for billion-dollar plus companies. And there's a whole bunch of examples that we saw this reporting season. Altium, Ordinate, both up 25% plus in a single day. Yeah, there was new information. It's good information, but it literally added hundreds and hundreds of millions of dollars in the case of Altium, like $1 billion, in a single day. WiseTech went the other direction, massive drop down, but also Accent, Whitehaven. There was just a bunch of really big moves.
The unfortunate thing of those three companies, the one that I do own is WiseTech. So,
oh man, yeah, that's always the way too. I've got too many of these. It's just embarrassing, really, where I can put my hand up and say, oh, I bought Altium years ago at like a fraction of the current price. But lest you think I'm a genius, like I sold like well ages ago as well at the time thinking, oh, look how smart I am. And I look at some of these results and go, why? Why did I do that for? And there's a hindsight bias to that. But at the same time, the rationale for selling was, oh, it's a little bit expensive. And I don't know how many times I need to learn this lesson, but really high quality companies, they tend to keep winning. And you not that any price is acceptable, but you don't want to be too fussy on it. And when I look at my biggest losses, it's the Altiums and of the world, where it's not that I actually lost money, but from an opportunity cost perspective, the loss was tens of thousands, if not more, of dollars, because I was just dumb, frankly.
So you say the market was jittery, but a couple of the companies there, jittery, you think negative, but like Altium was back. Like it's had a rough time and it was up a lot. So jittery on going both ways. What do we take from that? Just that like people don't know what to think, or?
I don't know. Skittish maybe is a better word, or just Altium's a good case in point, because for a long time now they've had this I'm going to forget it off the top of my head, but this very large aspirational goal. And it always seemed sort of ambitious, but they're more or less sort of tracking towards it. And with some of the commentary, some of the results is like, no, they're going to not only hit that, potentially even exceed it, and potentially sustain that momentum for a little bit longer. So I think in the year 2023, do we have more algorithmic traders? Are there more bots involved? I can come up with narratives that maybe sound really smart, but I don't know what the answer is. Here's the thing though, it's not bad. It's actually a good thing. And I don't think, no matter how advanced we get, whatever happens, I think we will always have this reminder that markets are generally not rational. They're certainly not efficient. And as investors, we should be terrified of the prospect that they ever become rational and efficient, because as stock pickers, we're out of a job. But we want like really dumb things to happen short term, and long may that continue to happen. Not that I'm saying it was a dumb thing with Altium, but there's a lot of examples out there where it's like, maybe ResMed is worth talking about. So the big sleep apnea company, like they've dropped massively. Again, they're a $10 billion company now after this 25, like lost a quarter of their value because of a new weight loss drug. And people, I think the market's assuming that obesity is cured and that no one will snore anymore. It's like, really? Okay.
It's a fascinating story. The other side of that story is fascinating as well. Novo Nordisk, the company that you're mentioning, about to become the most valuable company in Europe. I think it's right now the second most valuable company, and it's ripping.
Wow. If they're onto something here, like I'm old enough to remember, man, when gastro banding was becoming a thing, and people were freaking out with ResMed. Then it's like, oh, that's going to cure obesity. Like, is it though? Is it really? So maybe in this case, we saw the valuation was too stretched, and maybe things have just come back to normal. So I don't want to suggest, I haven't done the work. I don't want to suggest, oh, now things are really cheap. But it is an example of, that's really the only new piece of information. The case with ResMed, they posted incredibly strong revenue and earnings growth, good outlook, and the rest of it. So that's the thing that has changed. And all else being equal, is that in and of itself enough to wipe literally billions of dollars off this company? I don't know. I don't think so.
So one of the big takeaways was that the market is jittery. There's big movements. Good news for stock pickers. What were some of your other big takeaways?
My other big takeaway is that for all of the companies I hold, I didn't get those 30% re-rates. And it's been frustrating because, we've talked about this before where, as an investor, you want to have your investment thesis, why Peter Lynch, right? Know what you own and why you own it, right? I own this, and this is why I own it, because I'm kind of expecting this to happen. And every reporting season, even if it's a quarterly update or anytime the company releases new information, you sort of get a chance to sort of test that thesis. Like, were these assumptions reasonable, or at least directionally sort of reasonable? And I don't know, maybe I'm kidding myself, but I feel as though on a few of the companies, like tick, That's brilliant. Okay. I mean, not that there was like a massive out like, oh, that's much better than I thought, but I thought everything is going well
Yeah.
here. And in the case of a couple of companies, they're like dropped to lower in the Ava Risk Group. I think we've talked about before is something that I'm quite fond of. They had like a stonkingly good result, and shares were down like 7%, I think, in the wake of the results. It's like,
Right.
hey, that's weird. Now again, I say it sucks. If I'm trying to be more level-headed, it's like, well, that's an opportunity. I mean, if you ask, like on paper, what is the best possible setup that I can hope for as an investor? It's a company that is executing well and that the share price continues to fall. Like it's a good combination.
Yeah.
But I'd be lying if I said I'm happy that the shares have gone down.
Yeah,
I wish that
yeah.
they've gone up. For me, it's a reminder this earnings season, and it's not a new observation, but it's a reminder of the fact that returns never come evenly in the sense that it is gradually and then it's suddenly. And it's sort of like, I tweeted out the other day, Altium was a really good case in point. If you were an investor looking at your 3-year total annual compound return the day before the results, you got 2.5% per year. So you're there looking back at and going, I bought Altium 3 years ago because I thought it was a really good company, good prospects, share price was reasonable, and I've gotten less than inflation. Now, if you did the exact same calculation on the exact same company and you did it one day later, you've now got a 10% compound annual return over the trailing 3 years. So you've frame shifted that 3-year period one day, and you've gone from 2.5 to 3%. And that's a reminder that returns are not even on this market. And that's what's going to screw with your head because, when you look at a chart, you go, oh, it did nothing. And then all of a sudden it did something. And, that's what I should expect. But living through that 3 years, you can imagine, especially while the market's doing this, it's like, that is brutally tough. But that's how it goes.
Yeah. So you mentioned there that most of the companies in your portfolio you sort of looked at and you were like, tick. Were there, it would be great if there was an example of a company where you looked at it and you were like, oh, the thesis has broken, just so we could talk through it. I don't know if there is one.
I don't think so too much, actually. It's sort of, the reason being is that a lot of the ones that I'm rather fond of have got some hairs on them. And I think they just had their fall from grace. And so if I'm being honest with myself, and hopefully I am, and I'm being objective, the mistake I made was already revealed like 6 to 12 months ago, where there were some companies, and we've talked about Catapult before, we've talked about EnviroSuite before, talked about Pointera before, which really there's just some brilliant businesses, there. But things got a little bit carried away. The execution wasn't perfect. Like a lot of companies, they sort of were not focusing on cash flows and were only focusing on the top line there. And so the market came down when we sort of had this sort of sell-off in growth and tech. And hopefully what I did was reformulate the thesis and go, okay. So the worst thing to do is go, okay, made a mistake, that's it, I'm never going to look at them again. But I've invested a lot of time in understanding those businesses. So if I've done it right, I feel as though, okay, the mistake has been made, it has been revealed. But if I dust myself off and look at these again, acknowledging some of those shortcomings, and now looking at where the company is positioned and putting that in the context of the current price, where it's sort of like, gosh, there's a much lower bar to jump over at 7.5 cents for EnviroSuite, for example, than at 30 cents, right? So things maybe aren't as good as you initially formulated, but then again, you're paying a third of the price.
Yeah.
So, things can sort of work out. There are some scenarios, I think, where the signs are encouraging yet still tentative. So where they have seemed to have pulled back on costs, as a lot of companies have, but without taking the foot off the pedal in terms of necessary and reasonable long-term growth investments, and without having a detrimental impact on the top line. I mean, it's very easy for any business to sort of just strip all their costs away and their profit's going to look a lot better, but you're probably just hobbling yourself for the future. So I think there's sort of these green shoots that are there, and maybe the market's waiting for sort of, and maybe another quarter or half or a year down the track was like, oh yeah, it's encouraging, but I'm skeptical, I'm nervous. And then when you see a bit more evidence, maybe then the re-rate will come.
Yeah. So speaking of the re-rate and, people's sentiment and all of that stuff, I know you don't really think about the macro too much, but I know a lot of people will be interested in your thoughts on it. So inflation came in this week 4.9%, and there's hope of no more rate rises. I even read some economists talking about rate cuts next year. So, there maybe is some green shoots. We won't get you started on housing because we'll blow through our time and what's to come there. But do you get a sense of maybe sentiment's turning? Maybe some of these companies are starting to, invest a little bit more for growth and sort of, return to maybe not the crazy days of 2021, maybe return to 2019 days.
Yeah, right. I mean, you're right. I don't factor macro too much into the investing. I'm very much bottom up, but I do think about macro a lot because it's just interesting. It's not just from an economic lens. I think it's from a societal lens, right? Things tend to get pretty real when people are poor and desperate. So it's sort of interesting to sort of track, and geopolitically as well. So, I mean, we've seen what's happened with Evergrande in China, big property developer there, and then more recently, of course, we've had Country Garden. So it's basically losing billions and probably going to default on its bonds. A lot of lenders there are going to be out of pocket. And why is that relevant from the macro scene? Well, China's the second largest economy in the world, and they're our biggest trading partner, and they tend to buy a lot of iron ore, and they've historically bought a lot of iron ore to build apartments and roads and railways and stuff, and they're just overbuilt. It's just these ghost cities. I mean, this is not a new theme, but I think we are now starting to see evidence of these things blowing out. The word Ponzi gets thrown around too much these days, but literally the business models of these lenders were sort of take in deposits and sort of use that to build the next project, pre-sell them. It's just sort of it worked wonderfully well until it didn't. And I know that people like to go, oh, it's a command economy, so it doesn't, the rules of economics don't apply, but there is always someone has to pay the piper eventually. And the government might print money and save them all, but that just means that everyone's going to suffer through dilution and what we call inflation. So on your point with inflation, I'm very much of the view that we are going to have higher for longer. I think we've definitely passed the peak, but I don't think we're getting back to 2 to 3% anytime soon. And the RBA was recently talking about climate change and the impacts that's going to have on inflation, right? So that's pretty real. And there's just been a lot of trillions pumped into the system. So I'm a bit of an Austrian when it comes to the economics schools of thought. And I think inflation is a monetary phenomenon. And there's just, in the same way that we would understand that a company issuing a lot more shares is bad for existing shareholders, any economy where issues a lot more money is bad for existing currency holders. And I think that's probably going to be a phenomena. But at the same time, I feel as though, and the new RBA governor, I think, is making noises around trying to prepare us to just accept higher inflation. We're going to have to. In the US, they're talking about changing the 2% target.
Oh,
that's
really?
too low. We need. Oh my gosh, yeah. There's Krugman and others are saying, we need to increase the target. It's by the way, it's a completely made up target.
Yeah,
it's a fascinating
it's arbitrary.
story.
Yeah.
I think they literally went 2% feels about right.
Yeah.
And okay. So I think we're going into a period of higher inflation. We're past the 7-8% sort of mark, hopefully. But the reality is in Australia, and I can't avoid it entirely, I'm sorry, but I won't go too deep into it. But the reality is that so much property is the linchpin of so much of the Australian economy. And so many of us have put all of our wealth into it in a very highly levered sort of way. So you get to the point where I think the central authorities have this devil's decision to make, where it's just well, do we just all suffer some higher inflation for longer, or do we crash the property market and thereby crash the entire economy? Now, both suck, but which one sucks less? And
dash any hope of being re-elected. The political party that knocks this house of cards down, they're out.
100%. It seems like too basic a take, but obviously it is. Can you imagine a politician getting up there saying that no, we're going to make you poorer? And let's not forget that 2/3 of the country has exposure to housing in a very real way.
We often joke that 2/3 of Australians might have exposure to housing, but more and more every Australian has exposure to the stock market through their superannuation. They just don't really think about it in the same way. But imagine if the integrity of our super balances was such a political issue as our housing market. And every politician was like, we cannot see the stock market fall, how that would change incentives, how that would change policies. You'd have first stock home buyers grants, you would have first stock buyers grants, all of it. Tax benefits, yeah.
It's such a great point. But, it has become a religion in this country, and it like with property. And we have seen, how many times do we have to try and put in policies in place to add extra stimulus, whether it lets people to deduct money from their super to put into property or whatever. It never works, right? Because it just lifts everything up to the same degree, kicks the can down the road.
The latest is this shared equity scheme where the government now will just chip money in. It's the most direct way.
It's crazy. It's crazy. But I mean, the reality is it's just, I mean, I said I wasn't going to talk about it.
That's all right. Let's go.
Very briefly, is that we all talk about, we have to improve affordability. Now, I've got a 13-year-old son, right? And so he hears me ranting all the time. And he goes, doesn't that just mean prices go down, Dad? It's like, you'd think so, son. You'd think, as a 13-year-old, and I'm not saying he's particularly bright, right? But he's just like, that's the thing. We have this bizarre concept that we can make things more affordable without prices coming down. And you can't let prices come down, A, because of the leverage in the system, B, because of the knock-on consequences that it's going to have. So it's a really difficult scenario. I'm not calling for a house price crash, but I just think I could come back to earnings season for a second. So here's another thing I should have mentioned before. When you look at all the retailers, whether it's Dust Group or even Nick, like the really good ones like JB Hi-Fi and Nick Scali and they're all not, I mean, some have held up much better than others, but out of the commentary was, look, the first 8 weeks of the current financial year, we have seen sales fall substantially. And that is a very strong indicator of what is happening. So we're not seeing it in terms of defaults or anything like that on housing. And the bank's results came out actually pretty healthy, right? There's nothing wrong there. But of course, housing is the last thing to go. Like you will do whatever. I can live without another iPhone or a drone toy or something like that, or I don't need another scented candle from Dust Group, but I do need to pay the mortgage. And I feel as though that is a really interesting indicator of just how tough people are doing it.
Yeah, it is. And yeah, it's going to be one to watch. So final question, any last takeaways that we haven't covered yet? Anything that I should be aware of as you bring me up to speed?
I've made this comment elsewhere, and I think it's a good one. I'm saying it aloud more for myself. I think as investors, we feel as though during reporting season that we need to read, synthesize, digest, and react really quickly. Results are out. I've got to read it. Is it good or is it bad? And let's face it, we look at the share market. Is it up? It must have been good. If it was down, it was dumb kind of stuff. And more and more, I've actually got I think the work starts now after reporting season. The reality is, like, you're never going to be fast enough to read all of that, interpret it, digest it, and then make a sensible, calculated, calm decision that quickly where you can front run an immediate market reaction. So it's gonna, whatever reaction is gonna be, whether it's a 30% pop in the case of Altium or a WiseTech 25% fall, the horse is bolted, right? So take your time. Things are gonna we go from feast to famine. Things are gonna get really quiet in the next few weeks. This is, I think, the time to, away from the chaos of earnings season, to read things in a calm manner, make an informed decision, and go forward from there. It's true in life and it's true in investing. Whenever you make a rushed decision, it's usually a bad decision. And you were away for reporting season. I actually think it's a good thing. I don't think it's, unless you're some short-term trader, which I know you're not. I actually think you've avoided a lot of that distraction and that sound and fury. And now you can, and they're still very fresh. So these are very fresh numbers that you can spend the next coming weeks at your leisure without a requirement, it feels like, to react. to just digest, to contemplate, to think, and then if you need to react. And in many cases, you won't need to. So I would approach it like that, and I'm certainly trying to approach it like that.
Yeah, I love that. Well, I think that's a good sentiment to leave it on. The work starts now. I look forward to working with you, and I'll look at my portfolio and start looking at opportunities. And next time we chat, maybe I'll have a few companies that I want to pick your brain on, because I'm excited to get into the work. Back from holidays, refreshed and ready to go.
Roll the sleeves up. I'm here for it, man. I'm looking forward to it.
Nice one. All right, Bryce. Well, that was my conversation with Andrew Page. Always inspiring. Always leave those conversations motivated to get stuck in and go and research more companies. And then the world and commitments here at Equity Mates catch up. So
we've got 4 months until the end of the year. Not that there is any race or rush on anything, but do you reckon you'll make an investment based on anything you've spoken about with Andrew?
I've already made investments based on things we've spoken about. Yeah.
Tell us about it.
I'm constantly investing.
Constantly investing, you just said.
Call me Alan Kohler. I'm the constant investor. Topping up, opening positions, exploring the market. I'm wheeling and dealing. We just don't have time on Equity Mates to talk about it.
Tell us about it.
That's why we need more.
No.
Let's take a break, and then after, we're going to talk ESG investing. Equity Mate Steve sent us a message to follow up on an interview we did a couple of weeks ago about, I guess, maybe the pitfalls of ESG and socially conscious investing. So we'll get to that after this. All right, Bryce, we are talking all things ethical investing. It's clearly a big conversation in the Equity Mates community. In, I guess, the broader community, there's a sense that not enough is being done, particularly around climate change. And if we as investors can use our dollars to drive change, it's something we should do. Billions of dollars have flown into the space. Tens of billions of dollars have flown into the space. Every fund manager now has...
trillions are required.
Thank you.
No worries.
Every fund manager now has an ethical fund or talks about their ESG policy, which was why when we came across Professor Kelly Shue from the Yale School of Business, who had a contrarian take on ethical investing, we really were interested in speaking to her. Her view is that ESG investing is actually a net negative in terms of driving good environmental outcomes. Surprising opinion?
And I think specifically when we talk about it, it's the approach of divesting from brown companies or divesting away from companies that are high sort of carbon emitters. That's the lens that she's looking at it from.
Yeah, and the reason is if you don't invest in companies that need to change, it increases their cost of capital, their cost to borrow money or raise money from shareholders, and that they need that money to change their operations. So instead, because the cost of capital increases, they can't change, they become more short-term and they just sweat their polluting assets as hard as they can and make as much profit. Now, that is Kelly's theory. That's not a universally accepted view, but that's Kelly's theory. And it prompted this question from Steve.
You have one new message.
G'day, Equity Mates. Steve here. As a committed investor in ESG ETFs, your recent interview with Professor Shue got me wondering, should I stress or should I just invest? So I contacted one of my ETF providers, BetaShares, to ask for their take and received a pretty detailed response from their Responsible Investment Committee. In general, they said they agree with the professor's analysis, but they disagree with her conclusions as they relate to the real world. So, as investors in the real world, I thought Equity Mates might be interested in looking into some other perspectives on this topic. Thanks.
So I think it's great to see that we're generating discussion and forcing the Responsible Investment Committee of one of the biggest ETF providers in Australia to...
I mean, shout out to them for
responding.
Respect,
yeah.
I'd love to actually know what they said. Steve, can you send the response through?
Yeah, email us, contact@equitymates.com. We would be interested in reading it. We'll forward it to Kelly.
She wanted to know as well what the feedback from her conversation was within the Equity Mates community.
So we have featured a number of different views on ESG investing over time. 2 interviews that we'll include in the show notes that come to mind for me. Emily O'Neill, we spoke to, and then Adam Verway as well from Future Super. So a couple of other ESG interviews if you want to listen. But if you don't, let's sort of, I guess, unpack our views.
So my view has been that if I'm to put my money into an ESG investment, it has to be in one where I'm confident that there is, what's the word? Not petitioning, but like that there is...
Or like engagement.
Engagement being done.
Or activism.
Activism being done by the fund or by whoever is in control of that money to the extent that you're actively forcing change. I don't think that by investing in funds that sort of do a negative screen.
So in essence, you agree with Kelly?
Well, I had never thought of articulating it in that way.
Yeah.
But I'd always held the opinion that it doesn't feel like the right way to invest with an ESG focus. Yeah.
Yeah, and like you just think about, like, put yourself in the boardroom. Forget that you're an investor for a second and you're Rex Tillerson, the CEO of Exxon.
Hell yeah.
I mean, the former CEO, but I don't know who the current CEO is. You have an incredibly profitable oil business. You get paid incredibly well. And sure, maybe your share-based compensation will not be as high if your share price isn't as high. But like, you don't need capital markets that much. Like, you will be able to sweat the current assets. There will always be a lender, maybe not in the US, well, definitely in the US, but like, you know, there are lenders overseas that you could get capital from. There would, like Saudi Arabian Public Investment Fund would be happy to be a lender of last resort to you. Just like your incentives, because an ESG fund isn't going to invest in you. Like, you're not going to change what you're doing.
Yeah.
On the other hand, the question is like, if you're Rex Tillerson and this ESG fund tries to engage with you, like, are you going to listen to what they're doing? Probably not. But where we've actually seen change, and I chose Exxon for a reason, is shareholder activism. So engine number one, this is this tiny little hedge fund, I assume based in the States. They had a major coup where they challenged a number of board seats and actually, I think, got a couple of activists on Exxon's board at the shareholder meeting by just going hard around their company's efforts to combat climate change.
Great.
And so, like, that's an example where it's like a step beyond engagement. It's like adversarial activism, but there's getting enough shareholders on your side to drive, you know, at least some engagement, hopefully some change.
Have a voice.
Yeah, have a voice with one of the biggest oil companies in the world.
Yeah.
Yeah.
So, well, that's how I think about it.
Yeah.
And it feels like you're the same.
Yeah, I think divestment works to an extent. Like, you know, with the Rex Tillerson example, your personal incentives are, like, you're going to be okay either way. But I think on the margins, and I think with companies where they are, it's not an oil company, but it's a company that is polluting a lot, but has the capacity to change its operations. Take like a Coles, for example, you know, high emitter just because of the scale of the business and the footprint of the business, but can do a lot. Like, there's a lot of levers to pull. I think their divestment works because of the personal incentives of executives. And what I mean by that is most executives are paid most of their remuneration in shares. And so the higher the share price, the better. But also their long-term incentive plans often have triggers where if the share price reaches a certain point, they get paid more. And so, like, as an executive, your personal incentive is to drive the share price up. And my view is that, like, that personal incentive drives a lot of executive behavior, both in this ESG realm and just generally as well. And so if your executive team's personal incentive is to drive the share price up, and you know that by engaging with ESG funds, by changing your operations, there's massive pools of capital that you can access and that can drive the share price up, then that's a personal incentive to do the work and make the change. And I think that has an effect. So I think to that extent, divestment works as long as it's married up with, like, you are investing in companies that are doing the work and making the change. And like, Brad Banducci, Woolly CEO, would probably disagree with me. Actually, I think he said it publicly, like selling their pubs business, and because they were the biggest operator of pokie machines in Australia.
Pubs and pokies, yeah.
Woolies split that business off, and now Endeavour Group is separately listed. And part of the reason for doing that was because there was massive pools of global capital that couldn't invest in Woolworths because of their gambling exposure, like big Canadian pension funds, trillions of dollars that was sitting on the sidelines. But once Woolies split their business, they then could invest. So like that is an example of where divestment has like affected the personal incentives and driven an outcome. The flip side, and I know I'm on a bit of a rant here, but the flip side is Brad Banducci splitting off Endeavour Group did actually nothing to change the business of Endeavour Group. It just changed the ownership. Like there's not one less pokey in Australia because Brad Banducci made that change.
Yeah, but let's be clear, that wasn't the intention.
Yeah. So then it's like, you know, if you're a big diversified conglomerate and you say, well, we want this ESG money, we'll just split off our high polluting business and make it separate. It doesn't actually change anything.
No.
Yeah.
No. It's a challenging one because I think if you want to do the route of activism and whatnot, as a you know, in our shoes, it's not like there's just ETFs out there that are as easy to access as the divestment or the negative screen.
It would be an epic ETF, a highly active ESG ETF. It would attract a lot of funds.
Yeah, I think to Steve's question, the real world application, what's available for us at the moment is very much on the divestment side.
I should be clear, when I said highly active ESG fund, I don't mean like lots of trading, like an active management. I mean like activist, highly activist. Yeah. I mean, it is a view that we've spoken about this off mic a lot, that the ETF providers could do so much more in letting underlying unit holders like us, people that have invested in their ETFs, vote their shares. Vanguard says, hey, we're the biggest shareholder on every company almost around the world now. We're going to put this out to a democratic vote. Whatever our unit holders believe we should do, we will then drive outcomes hard. So rather than being a passive shareholder, it's like, hey, 80% have said we want to challenge Exxon's board nominations and put more climate activists on there. We got to listen to our unit holders. We're going to do it.
Or they go the other way.
True. Put more coal and more oil. Plenty of reasons why Vanguard wouldn't do that, but it would just be like an interesting thing for an ETF provider to try.
Nice. Well, there you go, Steve. Thank you for the question. Keep them coming in. You can hit us up at contact@equitymates.com. If you can shoot us through the response from BetaShares as well, that would be awesome. And we'll make sure Kelly gets feedback from her conversation with us, because it is no doubt resonating with the Equity Mates community. And on that, a big thanks to Mark Hesketh, who listened to our pitch episode with Equitize last Thursday. We had Vitable and Farmers Pick. If you haven't listened to that, make sure you do. We had two founders come in and pitch their startups, which was awesome. And we did a call out for the title of the session. Ren wanted to do Fish Tank. I wasn't so hot on that. So he has said that he loves the shows, and his suggestions are, here we go, pitch talk, pitches plus generating talk through your audience, TORQUE, nice. Pitch talk, TALK, pitch fork, scratch that pitch. Scratch that pitch.
Oh, like it.
Scratch that itch. Nice. Not bad, Mark. We'll take them to the team.
I don't mind the Mark, but I still prefer Fish Tank. It's perfect because it's like we're not sharks, you know. We're just little fish.
It, but it's still no. It's not good branding. Thanks for that, Mark. We'll sleep on that. If anyone has any other ideas, please send them in. And if you haven't listened to that episode, tune in.
And if you agree with Fish Tank, I need a groundswell of support here. So back me up.
No. Anyway, contact@equitymates.com. We're still open for suggestions and questions. But Ren, next episode, we will be speaking with Brent Beshaw, who's made 14 investments in 16 years.
Yeah, I mean, I'm sure a lot of Aussie retail investors have also just made 14 investments in 16 years. But Brent Beshaw, he runs a private equity fund, permanent equity, but it is true long-term investing, 30-year funds. Yeah. How that changes your investment decisions and your pace of investing, a fascinating conversation.
We loved it. Can't wait to bring it to you, and we'll pick it up next episode.
Sounds good.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.